Could China's potential collapse in real estate affect other countries and the United States? Stay tuned. Well, good morning and welcome to another edition of NoteSchool TV, where we go live every Wednesday at 11:05 Central Time. We have our monthly update for today, and we'll just call it the Thanksgiving edition, right? So remember that we are here for you every Wednesday, and we want your feedback. So this is for you. This is for us as well. So remember, if you like the content that you see every week, please click on the like and subscribe, right? Subscribe so that you can see all of the past NoteSchool TV episodes. And guys, they are amazing. And then finally, hit that bell notification so that you will be notified every week 30 minutes before we do go live, because again, you do not want to miss a NoteSchool episode. So as we move forward today, and right before we get into our monthly update, a couple of things here. If you would like more information about NoteSchool and what we do here at NoteSchool, simply go to NoteSchool TV or noteschool.com/TV and just drop us a line, and we would be glad to have somebody contact you. And certainly we would love to have you attend a one-day NoteSchool class, and stay tuned for more information on that. So with that, I'm going to bring on Eddie, and we are going to jump into the monthly update. So Eddie, why don't you jump on and let's get this started. The monthly update, November edition. Good morning, sir.
How are you?
I am great, man. I am excited that Thanksgiving is just right around the corner, and we get a little break, right?
Get a little break. We are excited about a lot of things that we have going on in December, and had a pretty incredible November, Joe, right?
Yes, we did. We started the month off with, Eddie, no brag, just fact, because I heard it from hundreds of people that Note Expo this year, the appreciation event and Note Expo year this year, was the best event, not the best note event, but one of the best events they had ever attended.
Yeah, it turned out really good, and I'm grateful for that. I have a team that does that. I don't want to take personal credit for it, but I think you and I are responsible for messaging in a lot of the ways that we do that at the event, and I think that was clear and timely, and I think what we're going to do today is going to be clear and timely.
Absolutely. You know, what we do here is all of this matters, not because we're trying to be contrarian or anything like that, but because what we want to do is just point out the creases, right? The opportunities that lay out there for all of us to, if we recognize them, for all of us to take advantage of, right?
You know, Joe, in the last housing cycle, 2008 and all that followed, 10% of the people weren't making their mortgage payment, Joe, but 90% of the people were making their mortgage payment, right? And not everybody lost their job. And so there were people that were completely unaffected by the market conditions, right? There were people that were drastically affected by market conditions. There were completely people that were unaffected.
Right.
And so now we have this boom, right? This housing boom, but there are creases in the market. And those creases, as you said, are how we recognize opportunities. Right. And, it's funny. Your first thing is about Zillow. And, 6 months ago, being in these high volume real estate masterminds that I'm around,
right,
there's kind of the high volume guys are flipping houses really to two completely different sources. One of them were the hedge funds. Right. And the other one they were flipping houses to were just the brand new real estate investor types, the HGTV dreamers, we would call them, right? And we're
That's
not
right.
making fun of them, but they're definitely newbies, and they're definitely excited that the older landlords were not loading up. The new guys that had never bought a property or only had one property were dominating that market. And then what was interesting, though, is that the hedge funds were dominating and Zillow was kind of leading the pack. And let's talk about that.
Yeah. So, we talk about this, and Eddie, as I was mentioning to you earlier, I had my real estate salesperson and broker's license early. And, when we were, many years ago, like I was 20 years old, and, one of the things they pointed out was about appraisals, right? About valuation of property. And it was always that appraisal is an art, not a science, right? And so maybe in a stable market, you can use an algorithm and kind of name that tune, right, or name that price. But with everything and all the different pressures, I think it turned out to be a little different, especially for Zillow, right?
Yeah. So how many markets were they in, Joe?
Zillow was in 23 markets. So you would have thought that, they were in every city and every state in the United States, but literally, markets like Phoenix and Tucson and Denver and Dallas and, just the bigger markets. They were in 23 markets. And really, in all honesty, they bought about 18,000 houses out of millions, right? And they flubbed up on some of them, and they'll pay the price. But, you've got the other companies out there like Open Door and OfferPad and Redfin Now, who are still out there trying to make it work. So, this is just one of those things that somebody made a little bit of a misstep, right?
Yeah. They were aggressive, and they've gotten rocked back on their heels. They're smart guys. I'm sure they'll figure it out long term. Once again, we're not making fun of them. We're just making an observation that somebody that came into the real estate investing world on the residential side bought 18,000 houses in 23 markets, and now have decided that pretty much that they've messed up, right? And
yeah,
so
the number one market they bought in was Phoenix, which is the number one, craziest market in the United States, right?
exactly. Anyway, keep your eye on that, and keep
your eye on it, and
other
we'll keep
hedge
you
fund
appraised.
buyers out there. We think that there could be some cautioning yet to come in that area as well.
Right. All right. So Eddie, I'm excited about this because every month that we do the update, we talk about the Black Knight report, and this really is a deep dive into. These guys do a very deep dive into what's going on in the analytics inside of the market here.
And just to point out, so you see the dates, I just want to make sure these are dated reports. But it is such a great report, and it lets us track the trending. So while it may be slightly behind in the date, it's definitely been a monitor that we've used ever since they came out with this as a result of the virus.
Right. And it's not that this is the latest data that has been compiled. We're not a month behind. This is the latest data there is that's out there, because they spend a lot of time making sure this data is correct. And that's what we love about the guys at Black Knight. Yeah. So Eddie, it looks like that, the national delinquency rate, over here, it's fallen below 4%.
Yeah.
But, that's, well, let's put that into perspective, Eddie. So between 1980 and 2006, the delinquency rate in the United States was less than 1%, right? And then, of course, we had the Great Recession, and, which we can all see over in here. And then we can see all the graph as we go across there. But it fell, which is good news. That's still a lot of houses, though, right?
Yeah, it's how you say it, Joe. If you say it in one sense, you say before the virus, we're 4 times the delinquency we had before the virus. When you say it that way, it don't sound as good as it. Well, it's only 4% now. So this is pretty much exactly how we thought things were going to fall. Right. What I'm looking at on this next chart, Joe, is the green line represents 30 days. The lighter blue line represents 60 days delinquent.
And look at
And
this.
that dark blue, go to that dark blue, Joe. That's the one that I'm interested in.
Right. This one right here.
That's the 90+ days delinquent, because being in the industry for a long time has shown me that if when you're in the industry for a long time, it has shown me that what that does and what that represents is those are loans that are less likely to ever get fixed.
Right.
And that number is not dropping. It is not dropping like these other numbers are subsiding. See, look at the 60-day number there, and it's sliding down below. So people that are 60 days delinquent or less, they're handling it. So this is a number to pay attention to, and this is exactly along the lines that we've said that we are going to have a pretty significant non-performing note instance.
That's right. So, and Eddie, this doesn't include the forbearance part of this, right? This here was
these are loans that are delinquent, Joe.
That's
they're
right.
Delinquent. They're not in forbearance, which means they're not delinquent. These are loans that are delinquent. So the next category are loans where they have a legal agreement to not pay the lender.
Right.
And there's a pretty good pile of those, huh, Joe? Well,
and we look, and so we've got the Fannie Freddie, the GSE loans over here, insured and guaranteed. Then the big pile over here is the FHA and the VA, and a lot of those were the lower money down loans, right?
Joe, I want you to slide down to the bottom category. Estimated monthly P&I advances on active forbearance plans. These are payments that loan servicers are making to the bondholders. That B stands for billion, Joe, in a month.
Yeah, I wanted to circle it. That's a negative number, right, for the servicers, Eddie?
Listen, that's a thing.
Well, and the reason that the servicers continue to make those advances is, if not, then the bond market would fail, right? Because these were sold as mortgage-backed bonds.
So the next part, Joe, is like, think in terms of you're heading in front of you. You live in South Florida.
South Florida. Mm-hmm.
I'm sure you've seen fog early in the morning.
Absolutely.
Driving to the airport many a time, right, before daylight. Yep. And all of a sudden it gets about that time, about 20 minutes before daylight, Joe, and you ever seen it just fog in?
It rolls in just like in the films, man.
Yeah. And so we have been talking about the fog coming into this business, the wall, right? And this wall is the forbearance plans are coming due. Joe, you highlighted where we are right now, November of 2021.
Right.
And man, we are at the peak of the market, peak of the cycle for GSE loans, government-sponsored entity loans.
Right.
And that's going to be Fannie and Freddie. And then we are at the peak of the cycle. This month, we're at the peak of the cycle for FHA and VA. By the way, remember, FHA has been as much as 14% delinquent in the past. Right. So let me just tell you, this is a monumental time that we're all going to be monitoring, because we kind of know that the perception, Joe, is we got 1.2 million loans in forbearance, and all of them are going to get, we're just going to roll all their payments to the backside of the loan. They're going to get modified, and these loans are going to be forevermore forgotten.
That's right. And Eddie, you got to remember that at one point there was 7.7 million loans in some kind of forbearance process.
But here's the thing, Joe. The thing is the people that are not, the people that have remained in forbearance and got extensions to forbearance, mm-hmm. These are far less likely to get modified than other loans.
That's right.
Right? That's what you need to pay attention to.
That's for sure. And Eddie, this next slide is pretty interesting in that this is the average UPB of mortgages, unpaid principal balances of mortgages or loans being refinanced, right? So if we look at we've got two lines here. These are rate term, so they did it to get a lower rate, lower term, which is some of the folks that were able to refinance. And then these were deals where actually people refinanced because their equity shot up in their property and they decided to capitalize on it, right?
Interesting. If you look at the price point, so you're at about 300,000 you're at about $300,000 for people just getting a lower payment.
Right.
But you're at about $200,000 for people doing a cash out refi.
Right. That's exactly right.
And by the way, cash refis have been dropping at a pretty monumental rate. You know, there's a big surge after the virus started. And this year, the refis have been substantially down from where they were in the past.
Right. And, you know, and this second piece here, the average credit score, we talk a lot about this when we talk about penalty box buyers in our classes, right? And you look at this and they go, okay, the average, well, it dropped a bit, but Eddie, look where it still is for, you know, it's north of 460 there for other refinance.
How about 760?
Yeah, that's what I'd be saying. 760. Yeah. Yeah. Now it dropped a little bit for below 750 on the cash out refinance, but my God, it's still north of 760.
Yeah, I mean the mortgage credit availability, and we're going to talk about that, right? Yeah. But it's up a little bit, but it's up a sliver, and it's still about 30% less than the people that could get credit before the virus. So we're still monitoring that. That is, once again, I want to go back to a point we made earlier, and that is, guys, the reason we make these observations is because we are in the process of buying non-performing notes and we're looking at the inventory. The reason we look at mortgage credit availability is that we're looking for the guy that's getting left behind by traditional mortgages because he's the perfect guy to seller finance.
There you go.
And so there's the reason that all this matters is those represent opportunities with people that can fill a gap that the conventional mortgage industry isn't filling. It isn't us poking fun. It's us finding opportunity.
That's it. That is the bottom line. And remember that there are many people out there. Again, they have good credit. They have money to put down. They fall somewhere there. They're self-employed, folks. 3 out of 10 people are self-employed. You know, they're gig workers. They're I-10. They're here buyers, individual tax numbers that are here. They're engineers. They're medical. They're smart people that are here, and they want to buy a house, but that's where they kind of fall short a little bit, is on that piece of that. So,
Joe, speaking of opportunities, I want to bring in our sponsor and talk about what we teach at a one-day note school class.
Well, hello, everyone. It is Brian with the teaching team here at Note School, and I'm excited that I get to be the one to invite you to the upcoming Gold in Notes class. That's right. It is a one-day deeper dive class that we call Gold in Notes because of how valuable this time spent is. This is a full day that we really get to dig into the nitty-gritty, the whole world of creative financing, not just how to acquire more deals, how to get access to more capital, how to defer a lot of the taxes for us as well as for the sellers that we're talking to, and really learn how to create your own notes. And really, once you learn how to create your own notes, this is really where we spend an entire afternoon really pulling back the curtain on what the note business is, from wholesaling notes, buying and holding performing notes to really build your wealth. I'll even show you a strategy called partials, which is by far the best wealth building tool I've ever seen in the real estate space. And we're definitely going to spend some time talking about non-performing notes, which is by far the biggest opportunity in today's marketplace, solely because of the events that have happened over the past couple of years. This is when people are not paying their mortgages, and we're going to make a lot of big money from these bad debts, and we're going to help a lot of people get a second chance. It's an absolutely fantastic day. Come spend a day really digging and discover a lot of this stuff so that you too can start building your wealth. It's a day meant to really be engaging. Bring your questions, bring your comments, bring your business problems, and we will see you there.
All right. That class definitely spends a lot of time taking the data that we cover in here and saying, where's the opportunity? So, let's talk about kind of the overall summary of delinquency and foreclosures and where we're trending there.
And, so Eddie, here's the thing, we are saying, well, it's, the trend is down, right? And we look here and we start out on the right side and we go back to the left and we are here. But Eddie, we're still 4 times higher than the average for years. And that still represents a big number, right? That still represents a number north of 2 million delinquent loans. Plus
and I'll tell you something else. We're starting to see foreclosures starting. The assets that we're seeing in the non-performing note world right now are called legacy assets. They were loans that were delinquent before the virus. And there is call it an avalanche of those, about 500,000 of those loans. And most of those loans that foreclosure's already been filed, they're in some process of, working down to a foreclosure. And now all of a sudden, when these next loans that we see a low foreclosure start, Joe, these aren't high numbers.
Right.
But this is going to become a significant number in the next months, and you can pay attention to this. By the way, Joe, when you talk about our world of non-performing notes, take 500,000 loans that have an average delinquency of, say, 36 months.
Right.
Right. That's 500,000 of those loans. So it's a huge number that's already out there. So we're working on that pile. This is like the pile that has been affected since the virus.
Right.
So little different story there, but good data and good information and good research on that, Mr. Joe.
Well, let's look at some state by state rankings. And Eddie, so if we look at this, I'll kind of point out and say, and by the way, that's not Los Angeles, right? That's Louisiana.
That's Louisiana. 8.6%. Show the delinquency too, Joe, just so they get a sense of. And Joe, what I was noticing in here is look at the South. That's Oklahoma. Below there, Alabama, Arkansas. Then go down to Georgia and Texas, and that's Alaska. But
I know. I saw that after I marked it right. South Carolina.
Interesting though that that a lot of the southern states, right, are 4% or higher. Yeah. And so we're paying attention to that, which we think is really interesting. Now, obviously, it's not just that. Maryland, that's pretty tough at 5%.
Yeah, no, it is.
These are like, if you went back, Joe, and looked at 2008, you would see these patterns. You had certain states.
Yeah.
They called it the 18 hardest hit states. In fact, they developed a program for that called the Hardest Hit Funds.
Well, that would have been Ohio and New Jersey and
the Rust
Indiana.
Belt. Exactly. The Midwest, the Rust Belt. Those are areas that were really hit in the last debacle, but we're paying attention to that this time. And man, Louisiana at 8.6%.
Big.
Whoa.
Well, look at you add the two numbers, the neighbors, right, of Louisiana and Mississippi, and that's 16% in those two states.
Anyway, so good observation there.
Yeah, I just want to point this out, Eddie.
When you look at non-performing notes, there's a pattern to what you're going to see there.
Exactly. So we got good old Idaho here now, Boise. And did you know, Eddie, that Boise is now, which is a beautiful city. We've got some great students that live in Boise, and now they have the crazy distinction of being the least affordable place to buy a house in the United States. So yeah, who would have thunk it, right?
Exactly.
So Eddie, I am going to you've done a lot of research on this, and that is what is going on over on the other side of the pond in China, and what kind of effect that could have on us. So I'll kind of flip through here as you talk, because I have control of the slides. So you let me know.
I will let you know. So a little bit of our cover story here. Here's the concern. China's real estate bubble. Experts are concerned about it becoming the Japan's lost decade scenario again.
Right.
And just to give you a sense, from 1989 to 2003, the Japanese Nikkei, that's the index, right? That's the average market index. It fell 80%. And by the way, it's never recovered to what it was before 1989 today. Right. So this is what a lot of experts are concerned with. And here's kind of the story. And this is, if you haven't been paying attention to this, you're normal, right? We're paying attention to it, but most people that we know in real estate or in the note related business are like, yeah, I hear they got some problems over there with some company in China, but I don't know exactly what they are, right? Let me tell you something, guys. This is potentially a nuclear bomb. I mean figuratively. I don't mean literally. But this is potentially a nuclear bomb. Essentially what's happened, Joe, is this. For the last 20 years, these real estate developers in China have been raising money, interestingly, a lot from just the rank and file people in the country. Okay. And there's an issue. So these pictures here, this company, China's Evergrande Group and Evergreen, and this is, man, let me tell you, you can start Googling this stuff, and it is a wild story. People are protesting in front of the buildings. They're basically wanting to tear the doors off and say, "Give me my money back."
Well, that's it.
So, Joe, go to the next slide here. So, these developers have accumulated $5 trillion in debt.
Yeah.
Now, this Evergrande company, they're the biggest, and they have accumulated $300 billion in debt.
Yeah.
Now, Joe, here's the catch. You know what their assets are worth?
Yeah.
Their assets are worth, if they sold them all, their assets at full face value, no discount, their assets are worth $200 billion. Now, Joe, I went to a little junior college over there in Fort Worth called Texas Christian University, and I was at the top of the math class.
Right.
But I can tell you from experience that this seems like a problem.
Yeah. Well, it's $100 billion problem for one company.
And by the way, they just liquidated their biggest holding. And let's see, I've got the notes on that. They liquidated their biggest holding, which was in a land development in Beijing, and they discounted it 27%.
Wow. Wow.
So maybe more to come on that.
A little bit more to come. Well, who invests in these? Whose money really are we looking at here as far as that invested in these developers, Eddie?
Joe, let me give you a sense of how invested they are in real estate overall. The real estate is 25% of their entire GDP. Now, you're getting ahead of me there, Joe. You got to go back.
Okay.
Real estate is 25% of all of their goods and services. 25%. Mm-hmm. Now, this graph, Joe, is billions. Okay. Right. So about $2 billion in debt service every month. So click that. Okay. $2 billion is what their debt service every month. But look at this green line that goes to $6 billion. That's a bump in debt service that Goldman Sachs has discovered. Now, I don't know why they discovered it. Just saying. But they've discovered that, and that is $6 billion. And Joe, that money is due January of 2022. So click it one more time. I've marked it for you. There you go. This is suspected that this could start the dominoes to tip over.
So that's the straw that could break the back right there.
Yeah, they built all these cities, Joe, that don't have any people in them.
Yeah, they're just
ghost cities, they call them.
Yeah. Wow.
All right, so no, go back. There's one more important thing. This is really, really important. 70. This is a Moodys report. 78 to 80% of all Chinese household wealth. It's not in stocks and bonds and gold and precious metals and cash in the bank, Joe. 70 to 80% of their whole household wealth is tied up in this real estate thing. I don't know what you would call a potential bomb, but buddy, I think they got one.
Well, this isn't the multi-millionaire, billionaire investor. This is there's 1.4 billion people in China. They have the largest population in the world, right? And these are the regular people, right? The people that have worked hard every day.
Yeah. So obviously it's not that we're not thinking that their stories is insignificant. We're just thinking our stories are more significant, Joe. Right. And the question is how much of a global economy we have. I don't think there's a question that they're in for a real estate crash.
Right.
It's suspected that this could be the decade crash, like Japan had. But the question is, Joe, is how this affects other markets and other situations. So let's go to, Joe, the next slide.
Eddie, if you'll remember our crash, 07, 08, it had ripples all over the world with countries as small as Iceland and Greenland and places like that, right?
All right. So the Federal Reserve, Joe, semi-annually, they do a most cited potential shocks over the next 12 to 18 months. This is done by the Federal Reserve. Okay. So click it for me there. It's going to underline number 3, and that's going to be property risk. Click it again, and it'll turn red. Okay. Then right underneath that, U.S.-China tensions. Click that. There you go. Again, go to the bottom is the China, quote, slowdown. Yeah. Joe, look at how many things that our Federal Reserve is saying is a risk to our economy based on what happens in China.
Right.
And so this is a real thing. And if this is something to pay attention to, there's lots if you're doing fairly in-depth research, there's lots said about it.
Mm-hmm.
We've kind of combined some data and opinions from various sources. I think it's a foregone conclusion that they're going to experience a real estate crash.
Yeah. Yep.
And it is a foregone conclusion that their rank and file people that were in the country are going to be all affected by it. Now, see, yeah. Joe, in 2008, you and I were in real estate in the note business. So right. 2008 was a big deal. Now, it turned out to be that black swan turned out to be a bonanza for us.
Yes.
Right. Because we were buying non-performing notes and doing creative financing, and we could go opposite of the market. But you and I know a lot of people in real estate that went broke, right?
Oh, a lot of people.
Let's call it a higher than 50% of all people that we knew in real estate went.
A lot of very smart people were just caught off guard.
70 to 80. Well, yeah. 70 to 80% of the wealth in China is tied to real estate.
Yeah.
So this is a thing, and you and I know that there's some scary thoughts out there that if they get really in a stress situation, that all of a sudden that might affect their actions.
Yes.
And that's why I think the U.S.-China tensions is fairly high up on the Federal Reserve's list. So
they would need to take some of the pressure off of the internal and project it somewhere else, right?
Let me tell you, if we've done anything today, we've at least put a bookmark in some things that now probably you're going to pay attention to. Right. Absolutely. And so we'll I'm sure we will continue to address it, but this was worth the timeliness of this was worth making a little segment of our show about this.
Yeah.
Go last slide, just a couple of little things, and that is other things that is in their GDP that really affect their economy is, did you know that iron ore has dropped 50% since the spring of this year?
Right.
Copper's dropped 15%. So this is further indications that their economy is waning, and this 3 times the normal debt service that's going to trigger in January. This is obviously has stock houses like Goldman Sachs, concerned about that. So a lot of information. And what I would say to you guys is this: find the opportunity in the middle of this. Don't just look for what is all great. Pay attention to what the voids in the market are telling you, and the voids in the market are going to show you some opportunities.
Right.
And as we talked about, a lot of what Note School teaches is identifying voids in the market and how that relates to an opportunity. Not just saying, we're not bantering, that the real estate market's on fire. What we're saying is that in an on fire real estate market, we have two variables. We really have three variables. Pay attention to this really closely, please. We have a burnout landlord factor that's as high as it's ever been.
Right.
Okay. We have landlords that have back rent of 8 million people owing back rent. Yep. We have a frustrated landlord factor that's really, really high. Yeah. There's some incredible note strategies that they wouldn't think of unless you thought of it for them.
Right.
Mark that.
We're on top of it.
Second thing is non-performing notes.
Yeah.
And there's an avalanche of non-performing notes coming into the market that small investors can buy. I mean, we have hedge funds that have more assets than our current student database has the capacity to buy.
Right.
Right. So we have a full bucket of opportunity there. And the third thing, the third thing in the market is the credit crunch. The credit crunch has caused us to be able to offer seller financing in creative terms to people in a way that we couldn't have done it before because so many people, could qualify for a regular mortgage. Those are the voids in the market that we think we can best fill. I'm sure there's others, but those are voids in the market. And I hope this has been helpful to you guys today.
You know what, I do too. And Eddie, I hope you guys are as well, are thankful that we provide you, right, with this timely information, tying it right back into Thanksgiving, right, Eddie?
That's it. You guys have a happy Thanksgiving, and keep paying attention to the market. That will show you where opportunities are.
And again, folks, thank you so much, Eddie. Again, thanks for being with us on yet another edition of Note School TV, where, again, we go live every Wednesday at 11:05. And for more information, to find out more about what we do at Note School, simply go to noteschool.com/TV, and we would love to connect with you. Thanks so much. Happy Thanksgiving, and we'll see you on the other side.